Now, this was widely expected. The RBI has delivered as well. A 25 basis point cut in the repo rate, the second in a row now, bringing it down to 6%. But this monetary policy was not just about the rate cut. It was about the message. And the Monetary Policy Committee has made that statement, officially turning dovish, shifting its stance from what was neutral to accommodative, clearly signaling that economic growth is under pressure. So the RBI is telling us in no uncertain terms that there are real threats on the horizon. There is the global slowdown, there are Trump's tariff tantrums, volatile financial market conditions, and a job market that is showing early signs of stress. But here's the catch. While inflation projections have been cut and the RBI says it is committed to non-inflationary growth, it is also flashing more than a few red flags. Job postings are really dropping. Companies are pausing their hiring plans. And even as India eyes this competitive edge from lower reciprocal tariffs, the short-term picture looks rather blurry. So with the fourth quarter earnings around the corner, FY26 starting on an anxious note for the most part, is the Indian economy walking a tightrope? Let's unpack the outlook for the jobs market, for financial markets, for exports and earnings with our Power Packed panel joining us tonight. Group Chairman at IndiTrade Capital, Sudeep Bandyopadhyay is with us. The Managing Director and CEO of CL HR Services, Aditya Narayan Mishra with us. And Chief Economist at IDFC First Bank, Gaurav Sengupta. Welcome all. Thanks for joining us on India Tonight. Mr. Bandyopadhyay, first to you. The market didn't exactly throw a party after the rate cut. Tell us what's bothering investors right now. Is it tariffs, the weak earnings guidance, or do you think it's something deeper?
Well, Vikram, I think it's pretty much the tariffs and the uncertainty surrounding it. If the markets had known that this is what it is, and then they could have moved on. But I think the volatility of the situation is making everybody nervous. We heard the US president talk about unprecedented tariffs, which is supposedly coming on pharmaceutical sector. Now, that's a big worry for India and Indian pharma companies. We are seeing escalation of the trade war between China and US on an hourly basis. Again, that's a big worry. Different other geographies like EU is planning to retaliate with their counter tariffs. Now, all this is kind of destabilizing global growth and global markets. Obviously, these issues are a major concern for Indian markets and also indirectly for the Indian economy. So obviously, the market is worried. Yes, RBI did deliver what was expected of it, and that was good. But market kind of factored this in. It was already factored in when we went into the policy. So there was no disappointment, but there was nothing extraordinary which came out of the policy. So market just shrugged it off and moved on and continued to worry about the volatility which is being induced from US.
But could the RBI have done something extraordinary, Gaurav? You think the RBI is moving preemptively with these rate cuts to tackle the global slowdown that the RBI chief has spoken about? Or do you see it as a rather reluctant move that has been forced by all the worsening global cues?
So I think they've done exactly what's required. Even without the tariff tensions, the 25 basis point cut in this policy, in April policy, was on the cards because inflation in India is now below the 4% target. And as they mentioned that they see inflation aligning with the target on a durable basis in FY26. So I think it's prudent to not overreact to the tariff situation right now because things can change very quickly. For example, suppose there is a bilateral agreement reached between India and the US, or suddenly US decides to give a breather on the tariff because it's not just negatively impacting the rest of the world, it's also negatively impacting the US. In fact, the US, there can be a significant price shock that comes to the US because of the extent of imported inflation that they have in their overall inflation, in their overall CPI basket. So they are facing a situation where growth, there could be recession risk, and at the same time, the US consumer could face a price shock. So, it could be a situation that suddenly that there is a pause on the tariff situation. So it's too recent. It's just implemented currently. April 9th is actually when the tariffs on India were implemented. So RBI is right now, the rate cut 25 basis points was very much in line with the domestic situation. But yes, the tariff situation adds to the depth of the rate cut cycle.
But Gaurav, now with the stance turning accommodative, how much room do you think the RBI really have to cut rates further, especially if inflation does rear its head again, something that you're pointing out?
So inflation will be an issue for the US. So the rest of the world will actually have deflation because the exporters will try to look for other markets because entry into the US is difficult. So you will actually see a situation where, let's say, China will aggressively depreciate their currency as a retaliatory measure against the higher US tariffs. So China will actively export disinflation to the rest of the world. US will face a price shock, but in the case of India, I think at least domestic conditions support another 50 basis point cut. This is based on the fact that our own inflation has come down to below the target level currently. We can see the tariff situation extending the rate cut cycle. So instead of a 50 basis point cut, we can have an additional instead of 50, it can go up to around 75 basis point cut or even higher depending on how badly growth is affected. But right now, our base case is two more rate cuts. We advocate for back-to-back rate cuts because the transmission lag tariff uncertainty can extend it to another, instead of two, it can become three rate cuts.
Fair enough. If that is the outlook and if inflation is not really as much a worry and the RBI is hinting in that direction as well, Aditya Mishra, what's the situation on job postings? It's something that investors today would also be looking at and people in jobs definitely so. Those job postings have come down significantly, and Exfino is saying that 70 to 80,000 roles have vanished from active listings. So do you see this as a short-term cleanup, or do you think this is some sort of start of a hiring winter?
No, I don't believe in a kind of a pessimistic outlook. I think whatever we are seeing right now in the market is just a temporary blip, and the world would automatically sort of find a new balance. Otherwise, it's going to hurt everyone. So I think it is just a temporary phenomenon. The jobs, that reduction in job posting, which you alluded to, is probably just a cleanup. We see some positives in certain segments, certain kind of jobs are being actually, the demand has gone up. While I agree that there are certain kind of jobs which have gone away because of several reasons, including the uncertainty in the trade war.
So with these kind of uncertainties, it remains to be seen how earnings are going to pan out as well, Mr. Bandyopadhyay. How do you see them shaping up for Q4? Because the hiring patterns are going to largely depend on how earnings season fares for us season after season. So what are you expecting this time? Do you see this one, another one of cautious commentary, conservative forward guidance? What do you see?
Well, a couple of things, Vikram. I think one is fourth quarter, which we had ended on, 31st March. Didn't have these tariff tantrums. I mean, they were supposed to come from 2nd April and they did come from 2nd April. So the chaotic situation which we are now discussing and dealing with is in the Q1 of current fiscal. So Q4 was relatively unaffected by those shenanigans. And, it will be a normal quarter. Now, by normal, I mean, there were challenges, there were growth challenges, there were, a lot of pressures and pulls. So we expect Q4 to be a shade better than Q3, but it would be nothing great because we had the demand challenges and demand pickup was not to the extent we would have it for the Indian economy. Some of the companies, like I'll give you an example of Dabur, came up with their numbers, which really points out that things didn't work out well as far as demand is concerned. So there was challenge in demand. So we expect a almost similar quarter with a slight better positioning vis-a-vis Q4. Now, most important thing in Q4 will be what the companies predict about the future going forward, what they're predicting, and this is particularly relevant for technology companies, pharma companies, because they are the ones which are facing the heat in US markets. Textile companies. So we have to watch the commentary which the management comes up with when they announce the quarterly results for most of these sectors, because that will be important.
But Mr. Bandyopadhyay, even as we consider what could come through in the kind of commentary that they put out and the guidance that many of these companies will put out, what's the mood right now, you think, in boardrooms? What do you reckon that they're thinking? Would they be holding cash? Would they be looking at cutting costs? doubling down on growth bets while these interest rates start falling?
Well, I think, the mood is very, very somber. I think people are trying to figure out what's happening. I won't be surprised if many of the companies come up with a statement that they are not in a position to give any guidance. That itself, in itself, will prove to the whole world that so much of uncertainty and so much of volatility, nobody is in a position to predict 1 month, why 1 month, even 1 week down the line, what will happen is not predictable at this stage. So
Right.
that's the status in which we are. And if IT gets impacted, pharma gets impacted, textiles get impacted, these are huge employers in urban India.
Yes.
We have to remember that. So that will somehow get reflected in the job numbers, which we track through multiple these the entities.
Aditya Mishra, do you agree about the kind of prospects when you're talking about jobs right now, that the key drivers when it comes to job givers within the economy, that's where the problems lie?
No, I think there are certain sectors in our economy which are driven by our internal domestic demand. The good news is that if you have a good harvest season and the demand for white goods, auto, and all those kind of improves, then our hiring is going to go up. Currently, I don't see any kind of stress in consumer goods, auto, let's say even healthcare, those kind of segments. I don't see any kind of stress at this point in time about recruitment is concerned. In IT, GCCs, startup ecosystem, there is a very interesting kind of a phenomenon. Certain kind of jobs which were being recruited in large numbers in the COVID time, of course, that kind of a situation doesn't exist anymore and probably will not come. However, there are new technologies which are coming up and organizations are trying to adapt them. So there is a huge demand for specialized skills of people. The lower end of the skills, which our people, many people have, of course, that in that segment, I see a stress, and because of more and more automation happening, AI wave happening, so that's kind of creating some pressure there. So people have to upskill themselves
Yes.
to vie for those jobs. The fact is today, the demand for such highly skilled jobs is pretty high compared to the supply that we have.
Right.
And the third point that I want to make is, of course, in the segments of manufacturing and infrastructure as a segment, there is quite a bit of a demand at this point in time. In manufacturing, there is a lot of movement from the unorganized segment of employment to organized segment of employment, which means that it is going to work well for us as an economy, and
Yes.
it will have a domino effect, a positive effect going forward. So I am optimistic. Of course, there is volatility, there is an uncertainty. No organization is able to predict that what's going to happen after 4 quarters. But I am optimistically, cautiously optimistic about the future.
It's nice that you first said optimistic and then said cautiously optimistic, which kind of surmises the mood in boardrooms as well, like Mr. Bandyopadhyay was suggesting. But Gaura, let me ask you, the RBI's GDP growth forecast, which has been brought down to 6.5%, and we were just talking about inflation, which the RBI has marked down. So do you see a longer-term structural slowdown in the Indian context? And which sectors of the economy are you expecting to be the worst hit? Would they be the exporters, since we're talking about sectors?
So basically, RBI has incorporated some impact of the tariff uncertainty. They've brought it down from 6.7% to a 6.5% GDP estimate. But if you look at the models, they've given it in their report, they're still seeing global growth at around 3% in 2025, which is similar to global growth that they saw last year. So they haven't really built in a significant slowdown in global growth, which the current level of tariffs, if they persist, can deliver. So I would say the 6.5 GDP estimate of the RBI has not really baked in the impact of the tariff shock. As per our assessment, if let's say the current tariff rates, which are astronomical, if they sustain, then the shock can be, instead of a 6.5% GDP, you can have a 6% GDP. That's when you really bake in the additional shock. So, as you rightly said, in terms of sectoral distribution, the export sectors will definitely see a hit. And you also see whenever exports are not doing so well, the manufacturing sector also doesn't do so well. The other impacted sector, if you put the tariff aside, has been the urban consumption, which has been slowing down. So even before the tariff noise, growth in India had begun to slow down a bit, especially the urban side. You look at FMCG companies, look at their sales volume growth. On the urban side, it has been weakening. And this is a reflection of low urban wage growth in FY25 and FY24. We had very strong urban wage growth. It slowed down significantly in FY25 as company profit growth slowed down, so did the urban wage growth, and that has affected the FMCG companies. Now in FY26, the risk is that the urban side stays weaker. Private corporate capex is another sector where companies will stay tentative because even without the tariffs, the corporate capex never kicked in because of the uncertainty in domestic demand, especially the urban side.
Right.
Now, with the tariff volatility, you have external uncertainty which has kicked in. So
Right.
these are the sectors that you could see some challenges.
So yeah, those sectors which we are talking about, Mr. Mishra, as well, in your understanding, as much as we'd like to be cautiously optimistic, but tell us, if we are to see a pause in the non-critical hiring, are we likely to see layoffs as well? If global recession fears deepen, if the shocks, like Gaura is pointing out, if they hit us that much more?
No, I think I'm not an economist to really predict whether recession is going to come or not. But I don't see really any large-scale layoffs which are going to happen. I don't see that problem.
But
It is just probably too much of reaction that we are seeing around. I believe that countries will bilaterally discuss and work out the path
But
which
Mr.
will work
Mishra,
for
the
for
lack of
everybody.
growth in our wages, now that's a reality that again Gaurav brought out. Don't you think that there are certain issues that domestically also we need to be tackling? And just the kind of shockers that are coming through the tariff route are just going to compound the problem.
Yeah, of course. I mean, it has an impact, of course, but there are also some positives. I think, for example, this MSME as a sector, it has got one part. MSME, let's not forget that that's the highest employer in our economy. So, if this repo rate change, which has happened, and it creates more money in the entire economy, and MSMEs are able to avail the credit which is available, and there is some kind of demand which gets created due to
Yes,
the certain positive changes
exactly.
in our
So if
core
there are
sector.
shifts to the supply chains, Mr. Mishra, do you see job
Yeah,
creation picking up in new sectors? And in that case, which ones would those
absolutely.
be?
Absolutely. I think the sectors which are really relying on innovation, that's going to happen. Those sectors are going to have more and more jobs.
Right.
So that's good. And then manufacturing, I already said
Yes.
that there are a lot of informal employment which is moving into the formal sector of employment. And probably for many organizations, in order to manage the volatility, they will probably go for greater degree of flexibility, which
Sure.
is required in their staffing plans.
Yes.
So they will probably go for some of those kind of employments.
Right.
So those are
Fair
things
enough.
that I see in the
Mr.
future.
Bandyopadhyay, from an investor's lens right now, you tell us how damaging are these global shocks, especially the tariff-linked risks, especially to India's long-term FDI and market appeal. Do you think we are facing significant risks on that count right now? And how long will that kind of risk stand?
Well, it's significantly damaging. Let's look at initially the FPI, FII investments into India. Now, US yield, treasury yield has already gone up to 4.5 and it's crossing 4.5. Currency depreciation is on an average about 5%. So, this two put together makes 10% as the minimum return which a foreign investor will look at before they even think of India. Now, if assuming they think of India as an emerging market, they will ask for a premium of 10% over this bare minimum 10%, which is inflation and US Treasury yield. So you're looking at an expectation of 20% return from an investment in India, which at today's date and today's condition looks extremely difficult. So
Right.
FDI inflow is to be muted till the time these disturbances are resolved.
Yes.
And that sure there's a pressure on Indian capital markets.
So, Mr. Bandyopadhyay, very quickly, if I can ask you, how do you think investors should recalibrate their portfolios? Should they lean towards defensives? Should they stay the course with the cyclical bets? And what's your advice to those who are sitting on the fence, whether they should deploy fresh capital, maybe do it selectively, or wait for clearer signals, like many are saying, wait for the dust to settle?
Well, from an investor's point of view, I will always say that nobody can predict the bottom nor can predict the top.
Yes.
So if you are planning for an investment into the Indian markets, there are still a lot of sectors and pockets which doesn't get directly impacted by this tariff-related volatility. So look at Indian power sector. Now that is one sector where there's a structural positive, and that's going to last for the next 5 years. India has been completely electrified. Demand for electricity is going through the roof. Every single segment of the electricity sector, whether it's manufacturing, distribution, power financing, ancillary, everybody is benefiting. So pick up good quality stocks in power sector, and I think there's nothing for you to kind of regret. Similarly, in the area of defense, we know globally rearmament is happening. India is focused on Make in India. Now, defense electronics is one area where there are some Indian companies, I'm not getting into the names, which are doing exceedingly well, and they are well-managed, efficient companies. Look at these segments. They don't get affected by tariff war because these are necessities beyond that. Look at domestic construction and infrastructure. Government is committed to do capital spending of 11 lakh crore plus, which is on an average 1 lakh crore per month, and it's gathering pace. So domestic construction infrastructure companies, good quality, which have corrected significantly in this latest downturn, it's definitely worthwhile picking up. The last point I'll mention is that if you're an investor, you want to build your portfolio, it's a good time. Start building slowly. Don't put all the money together to work on, on Friday morning, because there may be some further volatility, further correction.
Yes.
So keep investing in piecemeal, maybe 10-20% over the period of next 10-15 days. That's how you should plan it. If you're already invested in the market, please don't panic. Remain invested. Things will settle down. It's a matter of time.
Just a matter of time. And yes, Mr. Mishra was nodding in agreement very vigorously. Indeed, this is a delicate dance that the Indian economy is doing right now. We are dodging global shocks, trying to stay nimble amidst domestic demand concerns and hoping that the RBI's rate cuts will really set the stage for a more resilient FY26. The clouds of caution, they're clearly here, but so are the opportunities. If we can move fast, stay agile, use this phase, as it were, to build smarter, I think we would hit home. But a big thank you to my guests, Sudeep Bandyopadhyay, Aditya Mishra, Gaura Sengupta. Thank you for decoding the signals, helping us make sense of the road ahead. Thanks for joining us on India Tonight.
If you like this video, then like, share and subscribe to ET Now.